want to start today with a story that, frankly, sounds completely made up.
Okay.
It sounds like one of those urban legends, the kind you hear at a barbecue from an uncle who's had a few too many.
I love a good urban legend, but knowing our source material today, I have a feeling this one is probably backed by some hard numbers
Uh-huh.
and a very specific lesson.
It is. It is indeed. So let's set the scene. We are in New England. It's the 1950s.
Okay, got it.
And we have a guy, let's just call him Joe. Joe is a fireman. He's not a stockbroker. He's not a hedge fund manager. He doesn't have a fancy degree. He's just a regular guy, works at the local fire station.
The definition of Main Street, not Wall Street.
Completely.
Mm.
He's saving kittens from trees, putting out kitchen fires, has a family, a mortgage, the whole 9 yards.
And in the 1950s, the investment world was a very, very exclusive club. You didn't have apps on your phone.
Oh, absolutely not. You had to call a broker who probably charged you an arm and a leg for the privilege. But Joe, he notices something. He notices a local factory. It's run by a company called Tam Brands. Back then, I think they were mostly just known as Tampax. Now, Joe doesn't have a Bloomberg terminal. He doesn't have insider reports or a team of analysts crunching numbers for him.
He just has eyes.
He just has his eyes, which, as we're about to find out, is often a much better tool than any terminal. So he's driving past this factory every single day on his way to the firehouse. And what he sees is that this place is expanding furiously.
What does that look like on the ground?
I mean, we're talking trucks coming in and out constantly, 24/7. They're adding new shifts. They're literally digging up the ground to build new wings onto the factory. The whole place is just buzzing.
He's seeing the physical manifestation of demand. He's seeing a business that cannot keep up with how much people want its product.
Exactly. And he thinks to himself, using, simple fireman logic, well, they wouldn't be building like crazy if they weren't making money. They wouldn't be hiring all these people if they were about to go bust. So he takes this huge leap of faith. He invests $2,000 into Tam Brands.
Let's just pause on that. $2,000 in the 1950s for a civil servant.
It's a fortune.
That is a massive amount of money. That's not play money. That's we might not eat steak for a year kind of money.
It's huge. And he doesn't just do it once. He keeps putting in $2,000 every single year for 5 years.
Yeah.
He just keeps on buying.
So he's dollar cost averaging into a company he has a strong conviction about based on what he sees.
Exactly. But here is the kicker. By 1972, that fireman was a millionaire.
Wow. A millionaire from observing a factory.
A millionaire. He didn't buy some hot tech stock of the day. He didn't try to time the market swings. He just bought the company that he saw expanding down the street. And that story right there, that's the hook for today's deep dive.
It really sets the stage perfectly, because today we are unpacking One Up on Wall Street by the legendary Peter Lynch.
The man, the myth. And look, I have to be the skeptic here for a second, because the story sounds great. It's a wonderful little guy wins narrative. But is this realistic today? Can a regular person actually beat the pros?
That is the central question Lynch answers. And to answer it, we have to establish who Peter Lynch even is. He isn't just some theorist writing from an ivory tower. He ran the Fidelity Magellan Fund from 1977 to 1990.
And the performance was?
During that time, it was the best performing fund in the world.
The best in the world. So he's basically the Michael Jordan of picking stocks.
You could say that. He
Sure.
beat the market and beat it consistently. And yet, his entire philosophy, the whole mission of this book, is to debunk this idea that investing is some dark art that requires an Ivy League degree or a supercomputer.
He argues the opposite.
He argues the complete opposite, that the amateur has a structural advantage. The core theme we're going to explore is that the dumb money, which is what Wall Street calls us regular folks, is actually smart money.
But there's a condition.
A huge one, provided we ignore the professionals.
Okay, let's unpack this. Because on the surface, it makes no sense to me. I'm sitting at my kitchen table. I have a laptop, maybe a cup of coffee. I'm competing against a guy at Goldman Sachs who does this for 80 hours a week, has a team of PhDs in maths, high-frequency trading algorithms.
Direct lines to CEOs.
Direct lines to CEOs. It feels like playing one-on-one against LeBron James. How can Lynch possibly argue that I have the advantage?
It absolutely feels that way, doesn't it? But Lynch calls professional investing an oxymoron. He compares it to terms like jumbo shrimp or military intelligence.
Is that the brutal takedown?
It is, but he backs it up. And it all comes down to the structure of the industry itself. You have to look at the incentives of the professional. Wall Street is built on what Lynch calls the herd mentality.
Okay.
You have to understand that for a fund manager, job security is often way more important than maximizing returns for the client.
Wait, hold on. Isn't their entire job to make money for the client?
Theoretically, yes, but practically, their job is to keep their job. Lynch has this great quote. He says, "You'll never lose your job losing your client's money in an IBM."
You'll never lose your job losing money in an IBM. Break that down for me.
Okay, so imagine you are a fund manager. It's 1985. Everyone owns IBM. It's the safe blue chip, can't go wrong stock. You buy IBM for your fund, then disaster. IBM crashes, it drops 30%. What happens to you?
Well, I lost my clients a ton of money. I'm in trouble.
You did, but you can look your boss in the eye, you can shrug your shoulders and say, hey, everyone owned IBM. Who knew? The whole market just tanked. And your boss says, yeah, tough break. Carry on. You're safe because you failed within the herd.
Okay, I see where this is going now.
Now imagine you're that same fund manager, but instead of IBM, you buy Joe's Nut and Bolt Company, or that Tam Brands factory the fireman saw, a small, unknown company, and that stock drops 30%.
Now I look like a complete idiot.
Now you look reckless. Your boss calls you into the office and screams, why did you buy this garbage? Nobody else owns this. What were you thinking? And you get fired.
So the risk to your career is completely asymmetric.
Exactly. So the professionals, they all herd together into the same 50 safe stocks, which limits their upside and basically guarantees they'll just perform like the market average, maybe a bit worse.
They're handcuffed by their own career preservation.
They're playing not to lose instead of playing to win.
Whereas the fireman...
The fireman answers to no one. He doesn't have a quarterly review. He doesn't have to write a report explaining why he bought a company that makes tampons. He doesn't have to diversify to meet some compliance standard. He just buys it because he likes it. That freedom is a massive, massive edge.
And there's also the size issue, right? Lynch talks about the size problem. I have to imagine managing 10 billion pounds is harder than managing 10,000.
It's mathematically harder. Lynch calls this the law of large numbers working against you. If you are running a $10 billion fund, you simply cannot buy a $10 million company.
Why not? Just buy the whole thing.
Well, you can't. There are regulations against owning too much of one company. But even if you could, let's say you invest $10 million, a tiny fraction of your fund. Even if that stock doubles or triples a home run for you or me, the profit is so small compared to your $10 billion pot that it doesn't move the needle.
It's a rounding error.
It is. It's like trying to fill a swimming pool with a thimble. It just doesn't work.
So the big funds are forced to ignore the small, high-growth companies where the real explosive gains are.
Correct. They are forced to chase the elephants, the huge companies like BP or GlaxoSmithKline that have already done most of their growing. But the amateur can chase the mice, the gazelles, the small creatures that have room to grow into elephants. You can buy a stock that's too small for Fidelity to even look at.
And then there's the bureaucracy. I love this part of the book because it just reminded me of every corporate job I've ever had.
Oh, the meetings, the endless meetings. Lynch reckons that fund managers spend about a quarter of their time just explaining their picks to their bosses or to clients or on marketing roadshows trying to get more money into the fund.
That's a quarter of their time they are not researching stocks.
Precisely. And stocks, as Lynch points out, are not sympathetic. They don't give you an extra 25% return just because you had to sit in a board meeting explaining your strategy. The stock doesn't care.
Plus, there's the street lag. I found this fascinating. The idea that by the time an analyst actually recommends a stock, the party is often already well underway.
Or half over. Lynch uses the example of Dunkin' Donuts in the U.S. It was a 25-bagger. It went up 25 times in value before the big Wall Street analysts even started covering it.
That's incredible. So the analysts are waiting for it to be safe and established, but all the explosive growth happened while it was still seen as this weird new thing.
Precisely. Analysts usually wait until a company has a long, proven track record of earnings. They wait until the story is confirmed. But the stock price moves on the expectation of the story. By the time the earnings are confirmed, the stock has already jumped.
So who saw Dunkin' Donuts while it was weird and new?
The people drinking the coffee, the people standing in the queue, the locals, the firemen.
Okay, so let's summarize this professional disadvantage. They're too big to buy the interesting small stuff. They're too scared of their bosses to take risks. They spend all their time in meetings, and they're always late to the party.
That's a pretty fair summary, yes.
So let's flip it. What is the amateur's edge? Aside from not having a boss breathing down your neck, Lynch has this famous maxim, invest in what you know. But I feel like people really misinterpret that.
They do. They really do. They think it means, I like shopping at the store, so I'll buy the stock. And that's dangerous.
Right.
But before you even get to picking stocks, Lynch says you have to pass what he calls a mirror test.
A self-assessment, a vibe check on your own life.
Right. You look in the mirror and you ask 3 questions. And you have to be brutally honest with yourself. The first one is, do I own a home?
This threw me when I first read it. Why does owning a home matter for stock picking? Is he just being, a traditionalist?
No, it's not about that. It's about leverage and psychology. Lynch believes investing in a house is one of the few investments that is kind of rigged in the average person's favor.
What do you doubt?
Well, think about it. You can buy a house with maybe 10 or 20% down. That's huge leverage. If the house goes up in value, you make money on the whole value of the house, not just your down payment. You get tax breaks. And crucially, this is the psychological part, you don't panic sell your house.
That is so true. I don't check Zoopla every morning and scream, oh no, my kitchen value dropped 1% overnight.
Exactly. You don't have a ticker tape of your house price running across your living room wall. You live in it. You ignore the fluctuations. It forces you to be a long-term investor. It trains you in patience. Lynch argues that until you have that stability, you really shouldn't be taking big risks in the stock market.
Okay, that makes a lot of sense. It's like a training ground for your temperament. The second question is, do I need the money soon?
This is the don't gamble the university tuition money rule.
Which seems so obvious, but people violate it all the time.
Constantly. Lynch is very, very clear on this. The stock market is volatile. It goes up, it goes down. If you need that cash for a deposit on a flat or for tuition in 2 years, do not put it in the stock market. You simply cannot predict what the market will do in that short a time frame. You invest only what you can afford to leave alone for 5, 10, 15 years.
Because if the market crashes right before the tuition bill is due, you're forced to sell at a loss. You lose the option of waiting for the recovery.
Exactly. You become a forced seller, and forced sellers always, always lose.
And the third question in mirror test.
Do I have the personal qualities?
Which are?
Patience, a high tolerance for pain, humility, the ability to do your own research and to ignore general panic. Lynch famously says the most important organ for investing isn't the brain, it's the stomach.
The stomach.
Can you stomach a 20% drop without selling everything? Can you watch your net worth evaporate on paper and not panic? If you can't, if you're the type of person who loses sleep because the FTSE is down, you probably shouldn't be picking individual stocks. You will sell at the bottom every single time.
It's the emotional discipline. It's so much harder than the maths.
Oh, much harder. The maths is basic arithmetic. The emotions are what kill your returns.
So, assuming we pass the mirror test, we own a home, we have patience, we have a cast iron stomach, then we move on to the fun part, the hunt. Lynch calls this stalking the 10-bagger.
The 10-bagger. It's the most famous term from the book. He borrowed it from baseball.
A 10-bagger is what? 2 home runs and a double? Something like that.
In investing terms, it simply means a stock that returns 10 times your initial investment. You put in 10,000 pounds, it becomes 100,000 pounds. Finding just one of these can completely change your financial life. You can have 5 losers, but if you have one 10-bagger, you still win the game big.
And he says the best place to find them isn't in the Financial Times, but at the shopping center or the supermarket. This is the local advantage.
It is. And this is where we have to be careful not to oversimplify it. It's not just, I see it, therefore I buy it. It's about noticing trends before the official data captures them.
He talks about legs pantyhose,
Ah.
which is a real blast from the past.
Hanes, yeah. This is a classic example. Before Hanes was a giant, they launched legs. They sold them in supermarkets in those little plastic egg-shaped containers.
I remember seeing pictures of those. They were everywhere.
Now think about the Wall Street or City of London analyst in 1970. He's a man in a suit. He doesn't buy pantyhose. He probably doesn't do the weekly grocery shop. And he certainly doesn't hang out in the hosiery aisle.
So you have a massive blind spot.
A huge one. But women, they noticed immediately. They noticed these things were convenient, the packaging was clever, the quality was good, and they were buying them in droves. They saw the inventory turning over with their own eyes.
So if you were a shopper, you saw the buy signal months, maybe years, before the guys in the suits saw the earnings report.
Exactly. The same thing happened with Dunkin' Donuts. Or you could think of a UK example, like when Greggs started its massive expansion and everyone you knew was buying their sausage rolls. It wasn't about looking at a balance sheet at first. It was about noticing the product was good, the queues were always out the door, and they were popping up in every town.
And Pep Boys in the US, or maybe Halfords here in the UK.
Halfords is a great parallel. If you're a mechanic, or even just someone who likes to tinker with their car, you noticed Halfords. You saw the clerks were busy. You saw the inventory moving. You knew the business was solid because you were the customer.
But Lynch also warns about a trap here. He calls it the tech trap. And I think this is where a lot of modern investors get completely burned.
Right. He argues that amateur investors so often ignore what they can see with their own eyes, like a busy coffee shop, to invest in things they don't understand at all, like quantum computing or gene splicing.
Because it sounds smarter. I'm investing in graphene nanostructures. It sounds better at a dinner party than I invested in a sausage roll company.
Exactly. It's pure ego. Lynch says people invest in tech they don't understand, but ignore the shopping center they visit every single week. It's a tragedy. He has a simple rule. If you can't explain what the company does to a 10-year-old with a crayon, you shouldn't own the stock.
But here is where it gets really interesting for me. It's not just about being a consumer. Lynch makes a critical distinction about using your career. This is the professional edge.
This is a crucial, crucial distinction. Invest in what you know doesn't just mean buy the coffee you like. It means using your 9-to-5 knowledge, the specific, often boring details of your job.
He gives the example of doctors.
Yes. He says doctors are, as a group, notoriously bad investors.
Why? I mean, they're incredibly smart people.
They are. But he finds they spend their time buying oil stocks.
Which they know nothing about.
Zero. Meanwhile, the oil executives are buying pharmaceutical stocks because they heard a rumor about a new wonder drug. It's this comedy of errors. The doctor is playing the oil man's game, and the oil man is playing the doctor's game, and they both tend to lose.
So the doctor should be buying.
The doctor should be looking at what's happening in his or her own practice. Lynch mentions SmithKline and the drug Tagamet, or Merck. A doctor knows if a new drug is revolutionary years before the earnings report reflects it. They see the patients getting better, they see the side effects or lack thereof. They know if it's a blockbuster in the making.
And the oil executive.
The oil executive should be buying a company like Schlumberger or Halliburton. They know when drilling is picking up. They know when demand for specific services is rising. They know when the rigs are fully booked a year in advance.
There's a great line in the book about the chemical engineer.
Yes, the chemical engineer knows that demand for polyvinyl chloride is up and inventory is down 3 full years before the stock market figures it out from the annual report. That is perfectly legal insider information.
That's a key point. It is legal.
Absolutely. Illegal insider trading is when you use non-public information about a specific deal, like a takeover. But knowing your industry, knowing that, hey, everyone in construction is suddenly ordering this specific type of insulation, that is just doing your homework. It's not illegal to know your own industry better than a city analyst does.
That is a massive mental shift for most people. You don't need to read every financial paper. You just need to look at your own desk, your own warehouse, your own supply chain.
Exactly. What product is constantly sold out? What's on back order? What software is your company suddenly forcing everyone to use because it saves so much money? That's your lead. That's your starting point.
Okay, so we've got our leads. We see a busy store or we see a product flying off the shelves at work. But Lynch is very clear you can't just go out and buy everything. You have to categorize it first. You don't compare apples to oranges.
This is the next critical step, and this is where most people fall down. They treat all stocks the same. They expect a utility company to behave like a tech startup, and that's just a recipe for disaster. Once you identify a company, you must place it in one of 6 categories because you treat them all very, very differently.
Let's run through the 6. This is really the tactical meat of the book. Number 1, slow growers.
These are the large, mature companies, often utilities like National Grid or SSE. They grow about as fast as the overall economy, and maybe 2 to 4% a year.
So pretty boring.
Extremely boring, but steady. You buy these for the dividend. It's basically a substitute for a bond or a high-interest savings account. But Lynch's take is pretty blunt on this. If the company isn't going anywhere fast, neither will the stock. If you're looking for big growth, you don't waste too much time here.
Got it. Income, not growth. Number 2. Stalwarts.
These are the giants, the big, reliable blue chips. Coca-Cola, Procter & Gamble. In the UK, you think of companies like Unilever or Diageo.
Right.
They aren't sprinters, but they aren't snails either. They grow earnings maybe 10 to 12% a year.
So what's the strategy with a stalwart? You're not getting a 10-bagger here, are you?
Probably not, no. You buy them for a solid 30% to 50% gain, and then you might sell and rotate into another one. They offer really good protection during a recession because people still buy soap and whiskey, but they won't make you a millionaire overnight. Lynch calls them good ballast for the ship.
I like that. Okay, number 3, the Holy Grail, the fast growers.
This is where the magic happens. These are the small, aggressive, new enterprises that are growing at 20–25% a year or even more.
This is your Taco Bell, your Walmart in the early days. Maybe an ASOS or a Boohoo in their prime.
Exactly. This is the land of the 10 baggers, even 40 baggers or 100 baggers. But, and it's a big but, they are high risk. For every Amazon, there are 1,000 .coms that went to zero.
What's the key metric to look for here? How do I know if it's a future giant or just a dud?
It's all about scalability. Lynch looks for the cookie-cutter model. Can they duplicate their success? If a store format works in London, can it work in Manchester? Can it work in Berlin? If the formula is portable and they have a long runway of new markets to enter, the ceiling is incredibly high. You hold these stocks as long as they keep expanding successfully.
Number 4, cyclicals. This one feels really tricky.
The cyclical is, I think, the most dangerous category for the amateur investor because it looks like a stalwart, but it behaves completely differently.
Give us some examples.
Autos, airlines, steel, chemicals, house builders, companies where sales and profits rise and fall dramatically with the overall economy. Ford is the classic U.S. example. Here, maybe you'd think of IAG, the owner of British Airways.
And Lynch warns about confusing a cyclical with a stalwart.
It's a fatal mistake. People look at a big car company and think, oh, it's a huge company, it must be safe like Unilever. It is not. If the economy tanks, people stop buying cars and taking flights. A cyclical company can lose 80% of its value in a recession. Unilever might lose 10%.
And the PE ratio, the price to earnings, it can trap you here too, can it?
Yes. This is a fascinating counterintuitive point. Usually a low PE ratio is a sign of a bargain. But with a cyclical, a very low PE often marks the end of the good times. It means earnings are at their absolute peak, and smart investors are already expecting them to fall off a cliff. So you buy when it looks cheap, and then the earnings collapse and you lose everything.
So with cyclicals, it's all about timing.
Timing is absolutely everything. You have to watch inventories and commodity prices. You want to buy them when the industry looks terrible, when everyone is saying nobody will ever buy a new car again. And you sell them when everything looks amazing and profits are at record highs.
Which is the complete opposite of how most people think.
It's the opposite of human nature. You buy on the bad news, sell on the good news. It's tough.
Number 5, turnarounds.
The no-hopers. The potential fatalities. These are companies that have been battered, maybe they're near bankruptcy. Chrysler in the early 80s is the classic case study.
High risk, but potentially high reward.
Very high. Lynch points out that these stocks are often least related to the general market. If the FTSE goes up 20%, but the company goes bankrupt, you lose everything. But if the market crashes and that company somehow fixes its deep-seated problems, its stock can soar.
So it operates in its own little universe.
Correct. And there are different types. There's the bailout turnaround, like a bank getting government support. There's the restructuring turnaround, where a new CEO comes in and starts selling off bad divisions. The key question is always, is the bleeding stopping? Do they have enough cash to survive the surgery?
And finally, number 6, asset plays.
This is the pure treasure hunt. This is when a company is sitting on some kind of valuable asset that Wall Street has completely missed or is undervaluing.
Like what, for example?
It could be real estate. Lynch gives examples of retailers whose property portfolio, the land and stores they owned, was worth more than the entire stock price of the company. You were basically getting the retail business for free. It could also be patents, a huge cash pile, or a valuable brand name.
But you have to really dig for this stuff. It's not going to be on the front page of the business section.
You have to read the balance sheet. You have to look at the book value and ask, what are the assets really worth? It requires patience because the market can ignore these hidden assets for years, but eventually that value tends to get unlocked.
Now, I want to challenge this whole philosophy a little bit because we're talking about Peter Lynch in the 1980s. We're talking about malls, donuts, car parts. Lynch loves these dull companies, but we're living in 2026. We have AI, we have biotech, we have fusion energy. Does Lynch's advice to buy boring stuff still hold up? Or is it just a dinosaur strategy in a high-tech world?
That is the big debate, isn't it? Lynch was famously and very vocally skeptical of hot stocks. He preferred a company with a boring name like Bob Evans Farms or Consolidated Rock over something that sounded futuristic like International Gene Sciences.
Why? Is he just a Luddite? Was he just against progress?
No, not at all. It's pure economics. Lynch argued that boring businesses like making bottle caps or running funeral homes don't attract competition. Nobody graduates from Cambridge with a first in computer science and says, "My dream is to disrupt the bottle cap industry."
So they get a monopoly by virtue of being boring.
Exactly. They can grow for years without anyone noticing, and they can maintain high profit margins. But hot sectors like AI today or the internet in the late 90s attract every genius and every pound of venture capital on the planet. And that creates fierce, brutal competition.
And price wars kill profits for everyone.
Right. Just look at the dot-com boom. There were thousands of companies, but at the end of the day, only a handful like Amazon and Google really became massive winners. Most of them went to zero. Lynch's question is, why play in that minefield when you don't have to?
But, and I have to push back on this, if you ignored technology for the last 20 years, you missed Apple, Microsoft, NVIDIA. You missed the single biggest wealth generation engine in modern history.
That is absolutely true. And Lynch himself admits he missed some big tech moves. But his principle was more nuanced than just hate tech. He didn't hate technology. He just preferred to invest in companies that use technology to cut costs, rather than the companies that are inventing the technology.
Oh, the classic pick and shovel argument. Don't mine for gold, sell the picks and shovels to the miners.
Or the user argument, exactly. Think about it. Inventing the next generation of AI chips is incredibly hard. You have to spend billions on R&D, and if a competitor like Intel or AMD beats you to it, you're dead. But what about a boring insurance company that uses AI to process claims 50% faster and more accurately?
They get all the benefit of the tech.
Without the risk of the core technology becoming obsolete next week.
That's a brilliant point. So in 2026, maybe the true Lynch play isn't the startup trying to build a brain-computer interface, but the boring logistics company that uses that interface to move boxes around a warehouse 10% faster.
Precisely. Look for the earnings, look for the niche, look for the practical application. Avoid the pure hype. Lynch calls them whisper stocks, the companies that promise to cure cancer or end world hunger but have zero earnings. He says stay away until the earnings are real and proven.
Speaking of staying away, let's get really specific on the traits. Lynch has this great list of traits of the 10-bagger versus the traits of the reverse 10-bagger, the stock that's guaranteed to lose you money. Let's play a game. I'll give you a trait. You tell me if it's a buy or a sell signal according to Lynch.
Okay, let's do it.
Trait number 1. The company has a dull or even a ridiculous name, like Maui Land and Pineapple or Pep Boys.
That is a BUY, a strong buy.
Really? A silly name is a good thing.
It's a great thing because Wall Street and the city are incredibly snobbish. A fund manager doesn't want to call his wealthy client and say, "I'm putting you into a company called Pep Boys." He wants to sound smart. He wants to say, "I'm putting you in Stratosphere Advanced Dynamics."
Yeah.
The ridiculous name keeps the professionals away, which keeps the price low for you.
Okay. Trait number 2. It does something disagreeable or even disgusting. Waste management, funeral homes, cleaning industrial grease traps.
BUY. Definitely a buy.
Why is that?
For the exact same reason. It repels the fancy analysts. Lynch loves a business that makes people recoil slightly. If it handles toxic waste or provides funeral services, he loves it. It guarantees low competition. Who wants to disrupt the grease trap cleaning business? Nobody. So the company that does it well can make a fortune. Service Corporation International, the funeral home operator, was a huge 10-bagger for him.
Okay. Trait number 3. It's a spinoff. A large company splits off one of its smaller divisions into a new, separate company.
Buy. Spin-offs are fantastic hunting grounds. They're usually loaded with cash by the parent company. They have an independent management team who are highly motivated to prove themselves, and they're often sold off indiscriminately by big institutions who don't want to own a small, weird company.
Trait number 4. Institutions don't own it, and analysts don't follow it.
That is the perfect off-the-radar signal. That's a huge buy. If you find a profitable company with good growth prospects and zero analysts covering it, you are early to the party. You have a chance to buy in before the herd arrives.
Trait number 5. Insider buying. The CEO, the CFO, the directors are buying shares with their own money on the open market.
Buy. This is one of the strongest positive signals you can get. Lynch has a great line on this. He says, insiders might sell their stock for many reasons. They need money for tuition, they're buying a new house as part of a divorce settlement, but they only buy for one reason. They think the stock is going up.
And finally, a positive sign. Share buybacks. The company is using its profits to buy its own stock back from the market.
Buy. It's a sign that management thinks their own stock is the best investment they can make. It also reduces the number of shares out there, which makes your shares more valuable. It's mathematically beneficial to you as a shareholder.
Okay, fantastic. Now let's flip it. The signals to run for the hills. The reverse 10-bagger. The traps.
The danger zone.
Signal 1. It is the hottest stock in the hottest industry. Everyone at every party you go to is talking about it. It's on the cover of every magazine.
Sell. Or if you don't own it, avoid it like the plague. If everyone is talking about it, all of the good news is already reflected in the price. You are almost certainly buying at the top of the hype cycle.
Signal 2. It is being touted as the next something. The next IBM, the next McDonald's, the next NVIDIA.
Avoid. Lynch says, the next stock never is. When people say something is the next McDonald's, it usually means the current McDonald's is still doing just fine, and the challenger is probably about to fail. It's a marketing gimmick, not an investment thesis.
Signal 3. Diversification.
Ah, my favorite Lynchism, diversification. It's when a company starts buying businesses that it knows nothing about, like a successful supermarket chain buying an airline.
Does that really happen?
It happens all the time. Management gets bored or they have too much cash burning a hole in their pocket and they buy something completely unrelated to diversify. It almost always destroys shareholder value. Avoid companies that are losing focus on their core competency.
Signal 4. Whisper stocks. The long shots.
The ones that are going to solve all the world's problems but have no revenue and no earnings. Avoid. Lynch says the stock market is not a lottery ticket. If the company has no earnings, the risk is astronomical and you're just gambling, not investing.
And lastly, heavy reliance on a single customer.
Very, very dangerous. If 50% or more of a company's sales go to one single buyer, like a government contract or supplying a giant like Tesco, that buyer owns you, they can squeeze your profit margins to nothing, they can cancel the contract, and you're bankrupt overnight. You want a diversified customer base? Avoid.
This is such a practical checklist. But let's say we've done it. We found a company, it has a boring name, it does something dull, insiders are buying. We like the store. We're not done, right? We can't just press the buy button yet.
No, absolutely not. That is just the lead. That's the start of the investigation. Now you have to do the work. Lynch calls it the 2-minute drill.
Research. And this is the part that scares people off. They think they need to be an accountant or have a degree in finance.
You really don't. But you do have to move from the story, from I like the store, to the numbers, I like the stock. And that requires checking just a few key metrics.
Let's walk through the maths. Keep it really simple for us. What is the one number we absolutely need to look at?
The PE ratio relative to the growth rate. The PEG ratio, essentially.
Okay, unpack that for me.
PE is the price to earnings ratio. It tells you how expensive the stock is relative to its current profits. If a stock costs £15 per share and earns £1 per share, the PE is 15. But is that cheap or expensive? You don't know until you compare it to the growth rate.
Right.
Lynch's simple rule of thumb is this. A stock is fairly priced if the PE ratio equals the earnings growth rate.
So give us an example.
Let's say you're looking at a company, Fast Shoes Pessoas. They are growing their earnings at 15% a year. Their PE ratio is 15. According to Lynch, that is a fair price. You're paying a reasonable amount for that level of growth.
What's a bargain then?
A bargain is when the PE is half the growth rate. So say it has a PE of 10, but its earnings are growing at 20% a year. That is a screaming buy. You are getting very high growth for a very low price.
And what's a ripoff? What's overpriced?
That's when the PE is double the growth rate. Let's say the PE is 30, but the company is only growing at 15%. That's a trap. The expectations baked into that stock price are far too high. If they miss their earnings by even a penny, the stock will crash.
That is such a simple, elegant piece of maths. PE should be equal to, or ideally, less than the growth rate. What else?
Cash versus debt. Lynch loves a strong balance sheet. Cash is king. He has a great line. A company with no debt can't go bankrupt. It's mathematically impossible.
So when we look at the balance sheet, we want to see more cash in the bank than total debt.
Ideally, yes, or at least a very manageable amount of debt. This is especially critical for a turnaround stock. If they have a mountain of debt, They are on a timer set by the banks. If they have a pile of cash, they have time to fix their problems.
And inventory. You mentioned this earlier. It's something to watch.
This is the secret weapon for the amateur observer, especially in retail or manufacturing. Watch for inventory buildups.
Explain what that means.
Okay, let's say you're looking at a clothing retailer. You see their headline sales are up 10%. That sounds good, right? But then you look at the balance sheet and you see their inventory is up 30%.
What does that tell you?
It tells you they are making or buying stuff, but they aren't selling it. It's piling up in the warehouse. And what's going to happen next quarter? They're going to have a massive clearance sale to get rid of all those unsold clothes.
Which will absolutely kill their profit margins.
Exactly. So the great earnings they just reported are a mirage. The next quarter is going to be a disaster. The inventory buildup is the early warning system. If you see inventory growing much faster than sales for a couple of quarters in a row, run away.
This brings us right back to the professional edge. Because a store clerk or a warehouse manager knows about an inventory buildup months before the Wall Street analyst sees it in a quarterly report.
Precisely. If you work in retail, look at the back room. Is it overflowing? Is the manager panicking about space? That's a sell signal. If you're a teacher, look at what textbooks or software the school board is buying. If every school in the county just ordered a specific type of interactive whiteboard, that's a potential buy signal for the company that makes them.
So the rule is, use your 9-to-5 knowledge to find the leads, then do the 2-minute drill on the numbers to see if it's a good investment.
Exactly right. Don't ever skip the maths. The observation gets you to the door. The numbers tell you whether you should walk through it.
Now, we have to talk about the elephant in the room, market timing. Everyone always asks, is now a good time to buy? Is the market going to crash?
Yeah.
What if there's a recession coming?
And Lynch's answer is simple, and for many people, very frustrating. I don't believe in predicting markets.
He doesn't believe in it at all.
Yeah.
But he's one of the greatest fund managers ever.
He thinks it's a total waste of time. He says nobody can predict interest rates or the economy or market direction consistently. He uses this wonderful analogy about Mayan mythology.
The Mayans.
Yes. He says the Mayans believed the universe had been destroyed 4 times before, once by a great flood, once by fire, and so on. So they spent all their energy preparing for the last disaster. If the last destruction was a flood, they built boats. But the next one turned out to be a fire.
Meaning, we are always fighting the last war. We're always preparing for the last crash.
Right. After 2008, everyone spent a decade preparing for another global banking collapse. But the next crisis was a pandemic. The one after that might be a cyber attack or something else entirely. You can't predict the nature of the next crash, so trying to position your portfolio for it is a fool's errand.
Time in the market beats timing the market.
That's the cliche, but Lynch puts real numbers to it. He says, and I'm quoting here, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves.
That is a profound statement. Lost preparing for corrections, meaning you sit in cash, waiting for the dip, and you miss a 100% rally while you wait.
Exactly. You miss all the upside. Lynch's philosophy is simple. If you find a great company at a fair price, the PE matches the growth, the balance sheet is strong, you buy it. You don't worry about what the Bank of England or the Federal Reserve might do next week.
But he does have one little theory about market timing. It's not scientific at all, but it's brilliant. The cocktail party theory.
Oh, this is his guide to spotting market tops and bottoms based on how people treat him at social gatherings. It's fantastic.
I love this. Walk us through the 4 stages.
Okay, stage 1. This is the market bottom. The market has crashed. Everyone is terrified. Lynch goes to a party. When people find out he's a fund manager, what do?
They nod politely and then walk away as fast as they can.
They literally walk away to talk to the dentist. They want to talk about plaque. They want to talk about root canals. They would rather talk about painful dental surgery than talk about stocks because stocks have lost them so much money. Lynch says when this happens, it's a massive buy signal. The fear has maxed out.
Okay, stage 2.
The market is up maybe 15%. People will ask him what he does. He says mutual funds, and they might say, oh, that's nice, but isn't it all a bit risky? And they still walk away to talk to the dentist. They're still very wary. The market is up 30% or more. Now, people crowd around Lynch. They ignore the dentist completely. They're asking him for tips. What should I buy? Is Shell a good investment? Even the dentist is leaning in, asking him for stock tips.
So the enthusiasm is building. The herd is coming back into the market.
Right. But then comes the final stage, stage 4, the market top.
What happens then?
People still crowd around Lynch, but they aren't asking him for tips anymore. They're giving him tips.
They're telling the expert what he should buy.
Exactly. The dentist is grabbing Lynch by the lapels and telling him to buy this hot new tech stock he heard about. Lynch says when your neighbors start telling you what stocks to buy and the dentist thinks he's a financial guru, the market is dangerously overheated. It's time to be very, very careful.
I love that so much. It's a measure of pure social sentiment. When all the fear is gone and everyone is a genius, the crash is probably just around the corner.
It's anecdotal, of course, but it rings incredibly true. It's a barometer for euphoria.
So we've covered the oxymoron of Wall Street, the power of observation, the 6 categories, the traits of winners and losers, and the futility of market timing. We've really covered a lot of ground.
It's a dense book, but the core philosophy is actually very simple and empowering.
As we wrap up, what is the final provocative thought for our listener? We always want to leave them with something to chew on.
I think it's Lynch's fundamental challenge to all of us. He is basically challenging you to trust yourself. We live in a world that tells us we need experts for everything. We outsource our health, our car repairs, and we definitely outsource our money. Lynch is saying, stop, you have the edge.
And the edge is right there in your daily life.
It's right in front of you. The next time you're in a shop and you see a massive queue or you see a product shortage at your workplace, don't just complain about it. Don't just wait in line and get annoyed. Take a second and ask yourself, who owns this? Look at the name on the door. Look at the logo on the box. Write it down on your phone.
Because that might just be your 10-bagger.
It might be. That's your lead. Then you go home, you do the research, you categorize it, you check the PE and the debt. But trust your own eyes more than you trust the oxymorons on Wall Street. The best stock tip you'll ever get isn't in a newsletter or on TV. It's probably right in front of your face already.
I'm going to go walk around my local high street with a notebook. Maybe I'll check out the tire shop too.
Happy hunting.
Thanks for listening to The Deep Dive. We'll catch you on the next one.